So as we move on to this unit, this final unit, let's switch over to investment. And I have a question for you, Julia. Let's imagine, it's kind of where a little stock market stuff, but just go with it. Let's imagine you heard that there's a company, pick a company, any company, publicly traded company.
Yeah.
Yeah. Did you say NASA?
Yeah.
A company, no, a company that's publicly traded, not an index like Nasdaq or NVIDIA. And let's imagine you just heard that they had just released their earnings report. And it is better than expected. Right, there's been NVIDIA's had some bad news lately, and then they heard, no, actually, things are much better than we thought they were. This was just released. It was just announced on the news wires. This is the first time anyone's heard about it. It's not public information. How much time do you think you have to buy this stock before the price goes up? We would expect the price to go up. Right? So how long do you have? A few days. You can kind of like, you hear about that. I'm like, okay, I'm going to eat some breakfast. I'm going to go to the gym. Nap. Yada, yada. And then in like a couple of days, it'll go up. Does anyone think he has less time than that? Ilya?
It's already on the news. It's probably too late.
Well, it's already too late. It was just released.
Probably had 2 or 3 minutes at most.
Maybe 2 or 3 minutes. And we've gone from a few days, from 2 or 3 days to 2 or 3 minutes. Anyone think that that's too long? 2 or 3 days. Not going to be that. It is going to be less than 2 or 3 days. Anyone think 2 or 3 minutes is fine? No? Why not?
Computer algorithms instantly read it.
Yeah.
Makes trades.
You want to say anything?
Oh, yeah. So I wanted to say that the effort to look at this
Yeah. Yeah.
I would say, like, you're going to focus on this 1 minute. That's going to be up on it because if everybody's hearing it, everybody's going to have the same idea. And then they're going to try to buy the stock.
Yeah.
Which causes the price to shoot up.
Causes the price to shoot up. Yeah, so I used to say you had about 6 seconds from when, because there are people who are populating this and watching the news all the time, and they are out at the trading desk, and they would immediately sell the stock or buy the stock. That's what I used to say, but Anthony's right now. That is too long. You have to go through your time machine to do it, right? That's literally what you have to do, because you're right. There are now computer wires, there are now computer programs, algorithms that scan the news wires. And when really obvious stuff like that happens, like NVIDIA stock is better than expected, then it's programmed to then purchase that stock. And of course, it takes you time to read or listen and interpret what you're hearing. So, Julian, by the time that you are understanding what is happening, it's already too late. By the time that your brain has figured out, oh, this is good for NVIDIA, I should buy that stock, it's already too late. The price is already going up. For really obvious stuff like that, you see an instantaneous reaction. This is an example. The efficient market hypothesis. Has anyone ever heard that term before? I always abbreviate it as EMH. That's confusing to me. When I think EMH, I think emergency medical hologram. Thank you. So, it's really awkward when it's really quiet. What else could it possibly stand for? I think of Star Trek, but it also has another term. I guess probably. You ever heard of so you might have not heard of the term before, but you're probably aware of the concept. The idea is that the price of tradable assets reflect all publicly available information. And what this means in practice, that the best guess of tomorrow's price is today's price. You can put a little bit of asterisk next to that. Well, I mean, is that strictly true? Because sometimes the markets close and then some crazy thing happens, like, I don't know, putting tariffs on every country in the world, and then the markets will open the next day, and then if they will immediately fall, they have to wait to open to fall. Okay, sure, but that's just a stylized way of saying that if you want to know what's going to happen in the immediate future, your best guess is what's happening right now. If something changes, then you will see that stock price change immediately. Companies, when Trump announced all these tariffs, the stock tumbled immediately, even before the tariffs were in effect. Because they're like, I can see something bad happening, we're going to react now. If that changes, we'll come back. But it's going to reflect all, but nothing's changed yet, so we're going to act. We're going to act as if we're going to act on that information in mind. But didn't people already know that Trump was going to put some tariffs on? So I'm assuming, by the way, you've been following the news. That good Lord, how long has it been? It was the 2nd. It was the 2nd of April. So that was Wednesday. Last Wednesday. He announced the tariffs, and you would have noted, you probably saw that the stock market plummeted on because he announced it after the markets closed, and then the stock market plummeted the next day. But hasn't he been talking about tariffs the entire time? What happened? Why did the markets fall? So there's a part of it that he actually did. Right? That's part of it. Right? It's one thing to say he's going to do it. It's another thing to actually do it. That's true. There's another dimension to this. Most people think it was a bluff, like maybe he wasn't going to actually, like, so that fully reads into. It's one thing to say that he did. It's another thing to actually do it. Right? Of course, he did it his last administration. The last time he was in charge, right? He did it then too. So we had every reason to think he would. In fact, you start to see the markets even begin to tumble before that day because he started talking about putting tariffs on. It's like, oh, looks like he's actually going through with it. So why did they fall so much after he announced it? Not merely because he actually went through with it, but also.
Well, I'm just thinking in terms of like other people who are not in the U.S. investing in the U.S. stock market, like foreign traders, are kind of like. I mean, I guess it's the same thing as saying if he actually did it, but I think it's different for people in the U.S. versus people who in the countries and the countries.
Like maybe they're not following the U.S. news as much.
Yeah, until it actually
happens and makes news. It's telling like a rational ignorance kind of story, right? Yeah. So we have to be careful about it because under rational ignorance, it makes sense to not follow stuff. But in this case, it seems like there would be a very strong incentive to know what's happening beforehand. If you have if you're in another country and you invest a lot of money in U.S. stocks, right? And it's like, wouldn't you be following this carefully? So the reason why they fell isn't merely that he did it, it's because they were a lot bigger than everyone thought they would have been. So everyone was talking about, oh, we thought that there'd be some, and he was talking about, oh, a tariff over here, a tariff on Canada, a tariff on Mexico, tariff on China, and then he comes out with, I'm just taxing everybody. I don't care. I'm going to tax penguins. I don't care. I'm taxing everybody. You've heard about the penguin thing, right? Of course, we should be really clear. It's not taxing penguins. It's taxing the goods that penguins produce and send to other countries. Right? That's what a tariff is. So just so we're not confused. But yes, because they were bigger, right? Because they were bigger than what people expected. That's why we got the Trump. Because the best guess today is the best guess tomorrow. Okay. And then they keep dropping because there's new news. Like it turns out he's going to add a new tariff, or it turns out he is not backing down. And I think I noticed that the stocks are up a little bit today. I checked this morning because now there's rumors that he's talking to like the Prime Minister of Japan. A lot of uncertainty. Uncertainty creates wild markets because they're going off these little news. They're trying to get a little bit of what's going on, and it's hard to predict. Okay, well, what if we pick some sort of good, maybe some sort of commodity like steel, and we see that the price is doing this over the course of, say, the past like 3 years. Should you purchase? Should you buy steel? Yeah, why?
Because for me, I mean, buying it now, not the cheapest price, but it's growing.
Okay, yeah, right. But keep in mind, the past history is also publicly available information. You're saying it seems obvious that you should buy it because it has this upward trend. It does have this upward trend, and it is obvious, which is exactly why you should be suspicious. Because if it's obvious, what is everyone going to do? Buy it. So for all we know, yeah, it's possible to keep going, or it might stay the same, or it might stop. Right? You don't know. And maybe it'll go up, but maybe that's people's expectations. I'm not saying it can't go up. It could, right? All these places. But when we say publicly available information, that includes the history. And so don't look at a trend and say, well, I guess it's going to keep going. Maybe it will, maybe it won't. Right? Maybe people are overestimating it. Maybe it's going to blow up in people's faces. Right? Every downfall had a peak. The last thing to buy is going to peak. Any questions? Great. This was the theme of the ed puzzle I had you I assigned for you today. The brilliant versus boring ed puzzle. You want to comment on it? Because this leads us into what we're talking about today, personal finance. Do you have any thoughts on it? Yeah.
So from my understanding, the bet was that
Buffett?
yeah, Buffett. He made a bet basically saying that he could make more money and be more successful and he did that by he was the one that created the financing.
No, Jeff Bogle.
But he invested into the index fund that's up.
Yeah. So Vanguard is most famous for their index funds. They created them. Jeff Bogle? What was his last? Sorry, I'm trying to remember. Am I remembering his first name correctly?
It's John.
John Bogle? John Bogle, yeah. Okay. So, this actually is a fun history of this. So, the person who was before John Bogle is an economist named Paul Samuelson. I think it was Samuelson. And Paul Samuelson wrote a paper noting that all of these people who are buying stocks and purchasing stocks and picking stocks, they make money, but they don't make anything extra than what the market does on average. Sometimes they do better, sometimes they do worse, but on average, they're just no better than like what if you just buy all the stocks and just hold on to them and maybe put more weight on ones that have more activity and so forth. But just do it in a dumb way and just try to follow the S&P 500 average. You would do the same as these high-powered paying people do. And so Samuelson in a paper was like, will someone please make an index where people just buy stocks at an index and not have to pay these people god-awful money. They've got awful large amounts of money to pick stocks, not really doing anything. And John Bogle read that paper and is like, that's a good idea. And created the first index fund. And Warren Buffett, even though he's known for picking stocks and investing in companies, he's a big fan of index funds. And so he did index funds versus stock picking. Essentially, the stock pickers are trying to beat the market. Does anyone know what the term beat the market means? In the back.
Make more than the average.
Mm-hmm. Exactly. Make more than average. If the market on average is earning 5% and you earn 6%, you beat the market. If the market on average lost, 3% and you only lose 2 or 1, you beat the market. Right? You're trying to do better than average. And the whole point of the Brilliant versus Boring podcast episode is it's really hard to beat the average. Why is it really hard to beat the average? Yeah.
Because most stocks move the same average. Similar amount.
Well, but then you just select the ones that are good. Because not all stocks are doing well, right? If the average is going up by 5%, not all stocks are going up by 5%. Some are going up by 10%, some are going down, some are going up by 1.
At that time.
At that time, yeah. So just pick the ones that are doing well.
Can't pick right every time.
Because of the efficient market hypothesis. The best guess is what's happening now. Nobody has a crystal ball into the future. If they did, then we would see stocks just rise even faster, right? They would just respond faster. Yeah.
What if you're an insider?
Yeah. I'm glad you're bringing this up. So, some people do beat the market. Let's talk about how to beat the market. This is advice for people who do want to enter into, I don't want to call this advice. This is information that if people want to go and actively trade stocks, which I don't recommend, but actively trade stock, this is how some people beat the market. One, I guess we'll start with that one. That's not the one I have in my notes, but we can start with that one. What's insider trading? You mentioned it when you mentioned it.
When you have knowledge is not publicly available.
You framed it as being an insider, right? It's not technically the same thing. Why not?
Well, you could, like, if you work in the industry, then you can be barred from trading certain because you have that insider information. You know, if you work on airplanes and you know it's a very good model,
Yeah.
you cannot trade.
Uh-huh.
Well, there's a way to do it, but it's like,
Yeah.
but I guess you could like.
But like so, for example, Mark Zuckerberg is an insider when it comes to Facebook.
Yeah.
So can he not sell or buy Facebook stock?
He can, but it's a process. He has to set a price. It's within a time frame. He can't just sell it tomorrow.
Yeah. Because it's not illegal. But as you know, right, it's not illegal for him
It's not
to
illegal
sell. Because what's actually illegal?
acting on inside knowledge.
Acting on inside knowledge, right? Yeah. Right. So we don't want to say, oh, it's like insiders, people who work for the company can't buy and sell the stock. There's a process and there's things so they know that they're in a really great position to be able to take advantage. But you can't trade on insider knowledge. So Martha Stewart, for example, was famously accused of trading on insider knowledge for a biotech company called I Am Clone. She's not like a biotech anything, right? She's like a famous homemaker. And she doesn't know anything about like the patents in the approval process or the drug or anything. But she was accused of trading on insider knowledge because she supposedly got a tip. It is not clear actually if she was guilty. It doesn't seem like she was. She wasn't actually convicted of insider trading. She was convicted of obstruction of justice. And the accusation was they would ask her a bunch of questions, and she's like, I don't remember. And they're like, oh, obstruction of justice. So it's really hard to successfully convict people of insider trading because it's all about like what you knew and was that your motive? What you knew when and was that? That's really hard to figure out, especially if people know about that and they don't like leave, a digital paper trail. So I'm sure it happens, but it's very hard to detect, and I don't recommend you do it. Martha Stewart wasn't in jail very long. It still ruined her life. Just being accused, just actually going to jail for a little bit, because then she was a convicted felon. She wasn't allowed to run a company anymore. And the company went down the tubes. Like, it ruined her life. So you don't even want to get anywhere near this. You don't even want to be accused of it, because it can completely destroy your reputation. So I'm saying a lot of people don't get caught, is what I'm assuming. Probably does happen, because it seems like it's so hard. But that's because it's so hard to find people. If you do get accused of it, you're going to get a lot of attention, and you're going to get screwed. So don't do that. One thing I recommend that you do, though, in order to beat the market, is be lucky. That's great. That's the best thing to do. And this is obviously not actual advice, but we should recognize that we should not be fooled by randomness, because there are going to be people who will happen to pick the best stocks, and they will succeed just by random chance. If you have 100 people or 1,000 people in a room flipping a coin, you're going to get a few people that are going to get heads 4 times in a row. It's not because they're good at flipping coins. It's because they got lucky. That's just the nature of things. So don't be fooled by randomness. My actual advice, so this I don't recommend you do. This isn't actually advice. But this is something that is worth keeping in mind. Psychology. Look, people do panic. Traders do follow into groupthink. It's a very stressful job. People will do things because other people are doing them, so that if things go badly, they can at least tell their boss, well, other people are doing it, and it seems like not as big of a deal. So you will fall into this like weird incentives of people just doing what other people are doing and leaving money at the table. Those who can keep their heads in a boom or a bust can do very well. There's a great movie called The Big Short. Has anyone seen The Big Short? What's The Big Short about? Sounds kind of weird because it's big, but it's short. What's going on? Remember, Anthony?
2008.
Yes, that's right. Well, yeah, it was about 2008. Yeah,
It's about,
I can't remember when it was released, but
about those mortgages. How they were, they were marked out to be really high creditors, like bad. They were really poor. They were fearful that everyone was greedy, so they went off.
Yeah. So because there was a bunch of people who were like making bets, giving loans to people who couldn't make that much money, and a lot of this information about like default rates is public knowledge. And there was one guy who was like, "Oh, I see a lot of people are defaulting, or a lot of loans are really out of proportion with how much they make." Public knowledge. He's like, "I think this is a thing that's going to explode." And a lot of people will set up in groupthink, and they're like, who would not possibly pay off their mortgage? That's silly. Lose their home and ruin their lives. That's silly. No, it's fine. It's fine. It's fine. And he and a small band of other people were willing to go against the grain and not get swept up in things, and they made a ton of money. It's a really cool movie. That said, you don't want to lean too heavily on this. It's not like falling into groupthink is expensive. It's going to happen occasionally. It's not going to happen all the time. If it did, then you could make so much money. Screw groupthink. Most of the time, the market is right. There are just occasions where it slips around, where there are bubbles, where there is hyperbole, where there is overestimation, and those are the opportunities. And figuring out what those opportunities are and being able to act on them and go against the grain, that is a really hard thing technically to do, to identify them, and mentally to do, to be willing to be so weird and ostracized that you're going to do the opposite thing. But if you're that kind of person, this might be the job for you. Yeah.
Wasn't there just something yesterday where one of the major news networks incorrectly reported that like Trump was considering rolling back the tariffs and it made markets jump by like 5% in the span of
yeah. But then like that, I don't fall into this because he's like so unpredictable in the first place. It's like it's totally believable, right? And now the like Japanese prime minister is coming to talk to him, and now it's believable again. Like who knows? So in this case, there's just so much uncertainty, baseline uncertainty to begin with. It's like this isn't necessarily a groupthink story. This is like, I don't know, maybe that is happening. I don't know. It seems reasonable. It seems not. Who knows? This is more about everyone is agreeing this is the thing. Everyone's moving in the same direction, even though maybe it doesn't make sense. When you scrutinize it. Okay. So this is not actual advice for the most of us. Most of you will not end up trading. But you will be involved in the market because most of you hopefully will save for retirement. And this leads to basic investment advice. Yeah?
Would you quickly just redefine groupthink?
Groupthink is essentially I am thinking this thing because other people are thinking it. And we don't have good basis in logic. We're just thinking as a group, and I'm sort of reinforced in thinking this because I know everyone else is thinking it. So everyone's saying, oh, of course people pay back their mortgage. Of course they never default. If you're the one person that's like, I think they would, you are going to feel silly for suggesting something like that when everyone else is going to look at you and think you're crazy. And so that kind of reinforces people to think the same thing. It's easy to make a mistake if other people have made it. If you've done bad on like an exam, don't you feel better learning if other people did bad on the exam? If you messed up on a question and it turns out you're the only one that got that question wrong, you're like, oh shit, right? It's harder to mess up if you're the one person. It's harder to do something different because it's like if I'm doing the right thing, great. If I'm doing the wrong thing, or at least I can take comfort in the fact that everyone did the wrong thing too. Right? And that leads to groupthink. That leads to everyone thinking the wrong thing.
You're saying sometimes using information to avoid the groupthink and just being the market.
Yeah, but you have to. The information is never going to be easy to find. If it was easy to find, then we wouldn't have the problem in the first place. Just because it's public doesn't mean it's easily accessible. So it can take a lot of work and diligence to like go through the actual data and find whatever you're looking for. And even knowing where to look. But again, I don't actually recommend that people actively trade stocks. I will always get students who say, I actually traded stocks, it worked out well for me. I'm like, great, you might be lucky, maybe you have great psychology, I don't know. I don't recommend you keep doing it. I recommend to engage in some basic investment advice. Right? I recommend, like, if you're going to trade, let's see, I sort of changed this a little bit around a little. Oh, yeah. So, the advice I'm going to give you is going to be common Like I'm not a financial analyst. I'm not like there's sometimes credentials or sometimes what is it called licensing that comes around this. So I'm telling you things that is in every single basic investment book. It's even in textbooks. So I want you to keep that in mind. I'm not a financial professional, but everyone will tell you to diversify. What does it mean to diversify?
Buy multiple stocks.
Well, why is it nice to do that?
I guess because if some like one goes bad, you know, it's like all your eggs are in one basket.
Exactly. You want to invest in lots of different places, so you're not overexposed. You want to avoid something called correlated risk. For example, if I said, oh, I'll diversify, I'm going to invest in Amazon and Apple and Alphabet. And I'm like, this one is like retail, essentially. They're just like selling a lot of stuff online. And Apple is consumer electronics. And Alphabet is the parent company of Google. It's search. That's where they get most of the revenue, is search. So I'm diversified, right? No, why? Because they all begin with A? No. What?
Because they're all related to technology and the technology industry.
So what's the problem with that?
So if somehow like the tech industry does really poorly, then all three stocks may fall and lose their value.
Can you point to a particular event that would cause just that in just tech stocks to be?
I assume like a recession of like 2008 or like COVID really affected.
I mean, I don't know. Maybe some of these will be like maybe Amazon will do better in COVID
Oh,
because people are buying stuff online. Yeah.
Say, for example, like some sort of law negatively impacting data privacy.
Go right. So because recession is too big, right? Everything's good. It's hard to diversify away from recession. But yeah, if there's some sort of data privacy thing or regulation that would affect how people use their data, that would affect all three of these stocks. In other words, they're subject to that correlated risk. So it's like, but if I also had like a cement company, a major cement manufacturer there, like that would help. Bundles of investment that have the same kind of risk. If you have lots of correlated risk, you're not really diversified. Two, avoid high fees. So, what were the results of that brilliant first boring bet from the Ed puzzle? Which made more money? The stock pickers, using their high technology and huge brains and Ivy League degrees to find the very best stocks? Or Warren Buffett is like, I'm just going to buy everything and then walk away. A little bit of everything. Who did better? Buffett did, yeah, the index. So, which one do you think was more expensive? If you were to invest them yourself, if you were to purchase the stocks yourself, the index fund or the stock pickers? The stock pickers, right? People who actively purchase stocks charge a lot of money. They have larger fees. And they will publish the fees on your actual, when you buy, because if you open up, say, an account somewhere, you will have options for these are the kinds of things I want to do investments in, and these are the kind of strategies, and they will indicate the fees. Avoid high fees. This is the efficient market hypothesis. Index funds are cheap. And again, they perform just as well as people who are actively picking stocks. So don't Go with the cheapest one. Just go with the cheapest index fund. Now, when you buy this index fund, you might be tempted to look at the stock market. Like some people are looking at the stock market now, and then they're looking at their investments now, and they're getting really sad because the price has gone down quite a bit. You want to not do that. There's going to be shit that happens. You are not an active trader. You are not trying to play this game of buy and sell, buy one day, sell the next day, buy 1 hour, sell the next hour. You're not doing that. You are in it for the long haul. You're trying to save for retirement. And compound returns build wealth. Remember, that rule of 70. You want to engage in a strategy we call buy and hold. You purchase the stock and then you just hold on to it. Because it will grow over time. The stock market has roughly about a 7% real rate of return over the long run. It's going to go through wild fluctuations, but it has this very clear upward trend over the decades and decades and decades. And if you get 7% a year on average, some years are really great, some years are going to be bad. Like this year probably will be, but who knows? We're only in April. Over time, you're going to double your money, that initial investment, after 10 years, roughly. And then after another 10 years, doubles again and again and again and again. And pretty soon, you're retiring, and that initial investment is more than 10 times as large for inflation. Compound returns build wealth. So I recommend, and especially now, if you have extra money somewhere, I know it's hard because you're a college student, you don't have money, but if you do have money, you can scrounge something up, open an account, and purchase some stocks. My God, they are on sale right now too. Holy hell. So, and then you just hold on to it because you don't really care what happens to the stock next month or next year. You care about what it's going to be like in the next few decades. It's probably going to be a lot better than this. But you also must remember there's a risk-return trade-off. Does anyone know what a risk-return trade-off is? Yeah, you do.
Larger risk usually means the chance for larger reward, larger return.
Yeah. There are high-risk investments. And in order to attract people to make those investments that are high risk, they're offered a higher return. One of the reasons why the stock market pays so well over the long run is because it's so volatile. And it's really hard to, like, if you want to put money in and then you want to be able to liquidate later, that's really risky. And you are compensated for that risk, for that uncertainty, with a very high return. 7% is pretty damn good. Any questions so far? I'm giving you a lot all at once. Yeah.
What would you say is the best type of retirement account?
One that's cheap. What do you mean by retirement account? You mean like an IRA versus a Roth IRA? So this is not really something I talk to this board. This gets to the taxes, but taxes are going to be really important when you do your investment. So for those who don't know, an IRA stands for Individual Retirement Account. You put money into that account, and then your money is tax deductible. So you can then take the contributions up to a particular limit and say, I don't have to, I'm going to reduce my income by X amount, and I don't have to pay taxes on that. The problem is when that comes due and you take money out of your IRA for retirement, that is taxable. A Roth IRA lets you reverse that. A Roth IRA says, I will pay taxes on the money. I will not treat it as some sort of tax deductible thing. I will pay taxes on it. But when I take the money out when I retire, I'm not taxed. So, my colleague, Brian Bake, who's an accountant, might have had his class before. He was telling me, like, I think at one point he told me accountants have looked at this in multiple different ways, and for very narrow exceptions, the Roth IRA is better. The only big problem with the Roth IRA is you do have to pay taxes on money that you do not have, right? Like, I put the money in the retirement account, and then I have to pay taxes on it, right? So there can be a liquidity problem, but if you can overcome the liquidity problem, do it. And by the way, you can put money in an IRA, and then you can usually convert it to a Roth. And when you do that, then you're going to pay money. By the way, this is a great time to convert to a Roth because the stock market is down, and so your earnings will be less, and then you are converting less over. Yeah, David, did you have a question? Okay. So I'm low on time. This is my last little bite. This is application of risk return trade-off. Stocks are high return, high risk. What is going to be the opposite of this? What's going to be something that's low return, low risk? Emily, did you have an idea? No. Anyone know? Yeah, Nick. Bonds. Specifically, what kind of bonds? Specifically government bonds, specifically U.S. government bonds, treasury bonds. Because the U.S. has historically paid off its debt. If you loan the government money, it will pay you off. This has been going on for 2 centuries, more than 2 centuries. And so as a result, people see it as very low risk, which means you don't have to give people very much money in order to get them to lend to the government. If something is low risk, low return. You might wonder, what's the point of investing in it if the return is low? When you are young, like you are now, most of your money should be in stocks. Because all this fluctuation you don't care about. But I don't recommend keeping it all in, like some of these asset recommendations are like 95% in stocks. I do not recommend keeping it 95% of stocks all the way up to retirement. Because the problem is, if you plan to retire and then there's a recession, you're going to have to sell a bunch of your assets at a loss to maintain your lifestyle. Right? Because that's what you do, right? You build up this asset portfolio and then you sell stuff off in order to buy stuff, like food. That's the stage my dad's in now. He has a bunch of retirement, and he has to, by law, like sell some parts of it off. He's mandatory disbursement. So as you age, you still want some money in stocks because there's so good growth. But as you get older, you want to lock in some of those gains and sell the stocks and then buy bonds. Switch them over to bonds. I don't want to say most money in bonds. I think maybe there's going to be recommended, what's it called? Recommended allocations. They're all over the internet for details. Just use those. Oh, also too, on that Diversify, I forgot to mention this. If you buy an index fund, you're going to be pretty diversified. But if you buy an index fund for S&P 500, you're only going to be diversified in the United States. And thus you have systematic risk. You have some correlated risk because if something weird happens in the United States, I know that sounds weird and unlikely, but if it does, you're overexposed to the US. So you want to put some into international, buy some international indexes as well. And now you diversify for the whole world, that's better. But as you get older, you're gonna move that money out of stocks and into bonds. There are these options you can get called life cycle funds. And they basically have a year attached to them, like 2080 or 2085 or 2075 or 2070. Essentially, you pick a year that you think you would retire. And they will automatically reallocate your assets as you age from stocks into bonds. Do not get those because they're more expensive. Instead, they will publish how they will change your asset allocation as you age. Just write that down and do it yourself. Because that additional funds will add up over time. So just do it yourself. Like every 5 years on your birthday, celebrate by reallocating your investment accounts. Right? And don't have other companies do it for you. Because you're paying. But it's if you want to get a sense of how, what mix do you recommend? Again, I'm not a financial analyst, but there are financial analysts who specialize in this. Just do what they say. And they'll tell you for free because they have to tell you how this life cycle fund works. And then you just do what they suggest. All right, with that in mind, we're way over time, so I apologize for going over. I will see all of you next time. Have a great couple of days.